got folks from all over the place, Texas, and London, and Virginia, San Diego, Seattle, Wisconsin, Germany. All right.
Thanks for the shout out of someone who has been recommended Monpack to them. We appreciate that.
So as the conversation gets going between Ben and Monty, if you have a question, if there's something they're talking about in the moment and you have a question, throw it into the chat. So without further ado, I would like to turn it over to Ben Murray and to Monty Montgomery. I'll start with you, Monty. And again, welcome everybody to today's event.
Thanks, Don. Thanks for the intro. The SaaSonomics thing is, Ben and I have actually worked together for several years now. We've kind of realized lately that Ben has also trained a lot of CFOs in his methodology, and so we thought we would expand our service. So you'll see the deck, but I think it's sort of a compelling way to get your finances done and augment your existing finance accounting department if you don't have one, or to create one in general. So enough about that. You came to learn and not to hear us pitch, but Ben, thanks for joining. Always great to have someone with your deep background in all things SaaS and AI finance. Appreciate you joining the webinar. So obviously, AI is impacting all of our lives in the accounting profession, software development, obvious things. This today is not so much about how to use AI tools to speed up your accounting or make it more productive. That's worthy of several webinars, but more about how AI is impacting the business models when it's sort of the main driver of your revenue. It changes the standard metrics framework that we typically would use a little different because there's a bigger consumption element to it. The cost structure, the AI cost can get kind of out of control and need to be put in the right place in the P&L, and that's so we can do some analysis. And I think we're thinking ahead about how to structure your books and think about your business with AI as such a huge part of it. Anything you'd like to add about to that sort of preamble, Ben?
Yeah, definitely. I'd say just at a high level is really AI is amplifying the need for better accounting data, cleaner structure, because right now we want AI to do all the heavy lifting, do financial analysis and so on, create board reports. And now it makes it even more important to have clean accounting data, plus the other data sources that we need. And things are evolving. Whether we have internal AI spend, agentic AI, we're pushing AI through our product lines. That's actually changing how we're accounting now, and additional accounts that we need in the revenue and expense areas. So I think everybody now, we've got to stay current with what's happening, so we don't hit that board season, the fundraise, the exit, and people are asking for data that we don't have.
That's a great point. It's throughout it's not just on a monthly basis of internal reporting, but board reporting, what your investors and other stakeholders want to see, and then get to, great diligence smoothly to have great rounds and ultimately an exit. So in general, what are sort of the best practices around revenue recognition when you have this sort of usage-based or, the heavy AI inference costs that you need to charge for in the business model? How do you do that differently than sort of pure subscription?
Yeah, so now, right, whether we're AI or not, we have to categorize our revenue streams. So we have subscription, we have usage. This could be pure usage, rate times volume. It could be processing. We're taking a cut of GMV. We've got services, managed services, hardware, and other. Now with AI, we have to determine, all right, is that subscription revenue? Are we charging on a subscription basis? Is it usage? Is it prepaid? And Monty, yeah, that question comes up in my tech CFO community about RevRec on usage or AI usage, especially if it's prepaid, like prepaid commitments. And sometimes that could be recognized ratably over the 12-month term if there's a disassociation with token volume and the benefit you're getting, or if there's an association based on how many tokens you're using. So usage is not anything new, but it highlights the importance of having good, clean revenue categories, the accounting. And Monty, you see this a lot. I see this a lot with my clients, and our clients that, oftentimes they just have one revenue line, and now we've got to break that out into more detail.
Yeah, I think that's the key. That's always been a good practice to have more detail and granularity in your revenue types, but now there's another type. And and the scary part is, the gap and the rev rec may be different on that, which you bring up a key point. And then I think some people, are probably not charging on the consumption or not a lot nuance to it. Um, and that could be its own sort of pitfall. But when you're talking about metrics, how do you sort of like the old classics, lifetime value?
Hmm.
You're making a margin on the consumption, a margin on the subscription. You have to factor that into the lifetime value of that customer, therefore to look at, CAC relative to that. How do you project that?
Yeah, and I've got guys, if you want, hit me up in the chat. I've got some teaser slides that I can share with you later on some of the stuff to get you thinking, and teaser kind of brain teasers of thinking about, do we have the necessary financial infrastructure in place? So now we have, right, some of these, the traditional SaaS metrics still work, right? We've got payback, LTV to CAC on the go-to-market side, cost of ARR. But now, guys, and let me know, I'd love to hear in the comments if you're offering AI revenue on a subscription basis that is token-based revenue delivery, then yes, we can't use the normal LTV to CAC because you could have heavy users, light users, heavy users who are actually costing you money. You could have light users subsidizing your heavy users. So actually, things are ratcheting up, Monty, a bit where we need more data. We need more data from our product team. We need customer usage especially, and you see that, right? You see the change in the pricing models of GitHub, even Anthropic. And I even saw, I think today, Anthropic unbundled Fable from their subscription. So uh, you need to know more. Now we could have three LTV to CACs if we're offering token-based revenue on a subscription. So the same fundamentals, but now it's taking it that next step.
Yeah, it's a great point. I think the key takeaway is some of the things that you and I struggle with is getting that data. And if entrepreneurs can think about the fact that this nuance, this data types that will be needed as they're designing their systems to make it available for proper accounting. And and I think it's harder to figure it out later. There's nothing worse than seeing one revenue line on the P&L and then starting to ask questions. Um, so thank you for that. Moving on to related topic, which is sort of the billing and the pricing models. What do you recommend in terms of companies with heavy token usage? Do you recommend billing in advance or having tiers with thresholds?
Yeah, and that's where, boy, pricing is definitely art and science. And in my AI metrics course, I've got a process where you can go through and kind of figure out like, should I be offering subscription? Should it be hybrid? Should it be a platform plus usage? Should it be pure usage? And that's what I think all product teams and founders are battling today. So, um, yeah, and I think that's where we have to understand the underlying usage economics, how many tokens are being used by customer, to figure out, if we should be, if this is just, usage play and we bill in arrears like you normally see, in usage, or if it's platform plus subscription, or I'm sorry, platform plus usage, which you've seen a lot of these big tech players go to because they were not making money on their AI subscription pricing plans. You saw tons of changes, there. Even, Anthropic still continue to tweak their pricing model. So I think that's where Monty, I think really you've got to understand what's driving the delivery of your revenue. Is this just pure cloud hosting, normal stuff? Is this tokens? And then understanding customer usage behavior.
Yeah, that's a good point. it varies quite a bit from customers. I always like the model where you invoice in advance. If you say you're monthly, invoice in advance for your platform or your subscription, and then in that next month invoice, you look in arrears at the variable usage of the tokens, and you put people in tiers because people like predictable cost. And then I've seen models where if they jump a tier due to volume, then they're then in the next sort of monthly, the next range. And that sort of, to me, seems like something that's sellable as a service, but also protects the company's economics, on both sides, really. And it takes a little more accounting effort because you have to run a report, add that to each individual invoice, but that can be automated, obviously. But it seems like a fair middle ground as opposed to overcharging for underutilized. But what are your thoughts on that? Do you think that's sort of like a easy middle ground to start with and then go from
Yeah,
there?
and that's where it's interesting because your pricing model doesn't always equal like how your product is being delivered because like you said, the tiered, like when I was on Concur, right, it's really usage based, but it's usage packaged as a subscription in tiers. And I just
Right.
got this question, Monty, in my SaaS Metrics Foundation course from a student, is they said, well, I've got usage plus overages. Should I have separate GL accounts for that? And my answer is always yes, absolutely. You have to have, and for the founders out there or finance folks, hopefully in your chart of accounts, right, you've got GL to that level of subscription, usage, overage. Those have to be kept separate. Now you could roll them up how you want to, but at the GL level. So yeah, it's really interesting times now with pricing models, if you're usage, but you've packaged it as a tiered subscription, but we have to have that underlying infrastructure in our accounting and our chart of accounts to run the business and also run retention reports, run LTV to CAC, and then of course investors will want to see it.
Yeah,
On
definitely.
on this topic here, we have a question that came in right now. It
Yeah.
says, I am a startup offering fund services. My cost base is $4 per document extracted, and I have a variable number of documents extracted every month. We are going with tiered package based on the number of documents. However, we heard that this model creates a mental burden for customers. Tiers also creates unpredictabilities to CTOs. What do you suggest to use?
Yeah, I'd say that, well, one, do you have a hard cost to that $4 extraction? I'm guessing you do if there's like, I don't know if there's AI involved. Uh, but this is, yeah, you do. Yeah. Yeah. So that definitely dictates how you're going to set up your COGS structure for those hard expenses on this variable revenue. But I love to hear what you think, Monty, but the tiered structure, I think, well, one, it helps create I think predictability, versus just pure usage. And also it gives you that tiered subscription plus overage charges, which is a nice upsell for your customer base to say, all right, you can be on this tier if you go above that document level, you're going to pay $5, and hey, why don't I just move you up to that second tier? You'll get a better document rate and you don't have to worry. So I kind of like that model a bit because I think there's predictability. It also gives you great upsell potential.
Yeah, I agree. You got to look at it from different angles. It's like if you're out raising capital, what is the investment community looking for? They're looking for, pure margin, or looking for fast growth, or looking for predictability of your revenue stream. And when you lock people in under certain, tiers, whatever, with the ability to move up, it seems like it covers all the bases to a degree. But it varies. I think it's a good segue into sort of accounting for these compute costs, right? We used to kind of live in a world where there was, SaaS world at least, high CAC, fairly low COGS, it was a good model. You landed a client, there was a lower operating cost to keep that client, and the margins were good. And as long as your CAC to LTV made sense, you had a solid business. Now, CAC may be even more efficient with using AI tools to get clients, but there's higher variability to the COGS because of this usage, right? Um, so, every prompt can drive some inference costs. So it's a big number on the P&L, and it's kind of, your total AI costs are spread all over. What are your sort of thoughts about categorizing things in COGS for your AI costs? And
Yeah,
COGS
definitely.
is
And
cost of goods sold, cost of revenue.
yeah,
We're not talking about tangible goods, but it's an old accounting
yeah.
term, COGS.
Yeah. Oh, yeah. Yeah. I still use COGS, so old
Yeah.
school accounting term. But this, yeah, the question, great question, because then on the COGS side, and also one last note on that pricing, right? We've seen, right, these usage-based AI pricing plans, and then you hear from the company say, hey, just give me a subscription. I just need predictability, and then you can charge a premium for that because you're taking a little risk there. But on COGS, right, traditional SaaS COGS services if we have onboarding, customer success if they don't sell, uh, DevOps, traditional DevOps, which was hosting, your AWS bill, SSL, security compliance. But now we have this new category. If you have token-based delivery costs, in this document extraction, for example, I don't want that coded to cloud expenses. I want that coded, and this is what I'm telling everybody in their chart of accounts now is like to have a couple new accounts for inference spend, for that token spend in the COGS area. If you have any infrastructure related to that, observability, monitoring, you could have 3 to 4 different GL accounts that now we need to understand the true AI costs that it takes to deliver on your AI revenue.
Yeah, that's a good point. It's just well, what are your thoughts on product-led growth or freemium models and those costs associated with that? Do you just, for simplicity, put that into COGS, or do you break that out and put it into sales and marketing or more of a CAC?
Yeah, the freemium, yeah, I mean, rarely it's a good debate. Like you do see people think, well, if I have a free plan, that's really a marketing play. I'm trying to get them to convert to paid, so that should be a marketing expense and take a piece of hosting, put it in marketing. Rarely have I seen that in practice, but in theory, it does make sense. Usually everybody just has that up in COGS and DevOps and your full production facing, whether it's free, PLG, or paid. But you know, we could have a depends there because say you have 100,000 free users and 1,000 paying users, and a majority of your hosting costs are going towards AWS, for example, that's going to overburden your COGS expense. That's going to reduce your gross profit. People aren't going to be happy with that. So then maybe you would have to do some allocation between, marketing and the free plans. And then I've had some founders like, hey, I'm done with free plans. I'm done with the
Yeah.
tech support on free plans, and people are going to have to pay now to use. So a lot of debate on free plans now.
Yeah, that's a separate topic. But if it is a big part of your model, being able to pull the data of what is with the PLG or freemium versus paying customers would probably be good, just so you can analyze it and know what your true margins are on this stuff, which kind of gets to like, AI margins in general in SaaS. I mean, that's questions we're going to have to start answering to boards. They're going to start requiring this. Uh, what are your any thoughts on, how to what is should be good margins on AI? Do you pass it through? Do you make money on it?
Yeah. So yeah, now 2025, you saw public tech companies were breaking out AI ARR, right? Because in theory, hopefully that's growing faster than your legacy ARR. Now, the next step is we have to know the margin. Now, equity analysts, Wall Street analysts are asking public tech companies, all right, what is this causing margin compression? Is this accretive to your gross profit? And boards are going to be asking for that. We got budget season coming up this fall for 2027 planning. Now we need to know, all right, what margins are we getting on our AI revenue line? And I put a link in the chat to my AI COGS post. But we've seen, at first, Monty, it was kind of crazy. People like, SaaS metrics are broken for AI. AI companies will never be 80% gross profit. And we've seen some companies in the 50 to 60%. You see like the Iconic report saying they're in there if they're true LLM-based revenue delivery. But I've worked with founders, guys, who are producing 80% margins, and it's a pure AI-based revenue delivery. And again, it gets to what models you're using. Are these frontier models? Are these inexpensive models? So it's all over the place. So at the low end, maybe we're in the 50s, but still you can still produce pure play SaaS margins with an AI company.
That's a good point. So you have to have the infrastructure in place to track all that so you can answer these questions. But and AI usage is just across the organization now. And how are you advising companies to revise their chart of accounts for just basic use AI spend? And the funny thing that Uber, I think it was Uber that announced that by May, they had blown through their annual token usage budget. So it obviously, the adoption is there, the cost is there, and it could hit the P&L in a big way. And accountants don't like surprises. So are you advising companies to put more detail in the OpEx section for AI costs?
Yeah, definitely. When we look at the chart of accounts, I think we have three major buckets. One is tokens used in product delivery. That's going to be up in COGS. Those require, and these are things, guys, you should be doing today. And I was a panelist at an accounting conference a couple months ago, and there's a question from the audience, Monty, and I said, hey, we need these new GL accounts, and they raised their hand, and I think they're the controller. They're like, hey, my CFO doesn't want to add any more new GL accounts. And it's like, I get it, right? There's a balance there, but we do need, and I think there are three buckets, Monty. One, of course, is inference spend and COGS, and there are a few
Yeah.
more there. So we need more GL counts there. Two is just internal kind of AI efficiency tools. If we're using ChatGPT to create that landing page, sales and marketing material, again, no different. That software should get coded back to the departments who's using it. But I don't want this coded to internal use software. I want a new AI tooling bucket, so we can keep that separate from just legacy internal use software tools. And then the next one is if we have agentic spend that is meant to replace a person on the org chart, that's digital labor, and that needs its own GL account. These are things we should be doing today, right now, that we can take action on. So, because the big debate is like, are we having ROI from all this agentic spend? So
Right.
that's what I'm going through with our client base right now is we're adding a few more GL accounts, especially for those legacy SaaS companies, so we can, like you said, so we don't get too far down the road and we don't know where any of these expenses are buried.
Yeah, that's a good point. And I always, am kept up at night of the thought of someone not having an expense, but using the free version and putting some sensitive data into that the
Yeah.
model sort of then trained on. I think it's worth whatever it costs to get a paid version, just so your data is more private, your trade secrets are more private. And one sort of semi-alarming anecdote is that a friend of mine was responding to a state RFP and just asked the chat public version, what are people doing to respond to this? And a couple of people had put their proposal through ChatGPT free version to be cleaned up, and it trained on it, and it gave my friend all some insights as to what people were bidding on this content. That's just
Wow.
funny. It's funny, but it's scary and stupid. So pay the $20 or whatever it is for the private.
Yeah, I've got to pay ChatGPT, Gemini, Claude, all that good stuff. So yeah, definitely worth it. That's where we have to have this tracking, especially when we go into budget season, if we're a decent sized company, departments are going to want more AI spend and it's got to come from somewhere. So that's why I keep saying, kind of preaching a little bit is like the time is now. We've got to do our homework now. So we're ready for this fall for budgets and just that next board meeting.
Yeah, good point. And budgets and projections, that's kind of tricky because we're still getting the utility out of these AI agents, and some of it's low hanging fruit, others more complex. But we have to rethink as finance people and as entrepreneurs, people versus agents, right? The digital labor. How are you building in that into your FP&A process now? And what are sort of the underlying assumptions you're thinking about? Future costs going down or up? Usage?
Yeah, what I've seen, it's a whole mix, and I'm helping a lot of legacy SaaS companies, which most of our are, we are, and it's a slow evolution, and that's where, all right, let's put in these new GL accounts. All right, we're starting to push a little, AI product line out to our customers. Let's make sure we're tracking inference spend there. And then, if we have true agentic spend, we're tracking that separately. So it's a bit of a balance where now, yeah, we don't have to hire as fast or as much because, especially, right, we know on the dev side, that's picking up a lot of lift on the coding side. So I wouldn't say I've seen drastic changes other than it's just maybe changed the trajectory of hiring for legacy SaaS.
Yeah, that makes sense. I mean, even we have a small dev team and we had an open rec that I approved and they just said, yeah, we don't think we need it. So
Mhm.
like, great. Um, but I don't think you want to be too conservative about that. Otherwise you may find that you do need it. The, I think that this sort of reminds me that whenever you do a model, it sort of starts with a great chart of accounts in your actual set of books and then model based on that so that you can do these comparisons. So you can track your token usage, for example, by department and make sure that if everyone is projects and maybe you do a bottoms up type of model process once a year, budgeting process rather, and that it's in it. That's just a bunch of guesses, obviously. You have to stay on top of that throughout the year and make adjustments. So more detail, more nuance into that would make that whole process easier as you manage it throughout the year and start to answer questions the board's going to ask.
Yeah.
Um,
Monty,
so
really
we
quick here. Sorry,
question,
apologies.
yeah.
We have another question here. Pre-seed startup transacting with companies in the US and in the EU with a limited budget for accounting. Are there any software solutions or ways to handle multinational transactions and maintain proper accounting with limited resources?
It's a great question. You know, to keep it simple, where you have, if you have one entity that's generating revenue in all in one jurisdiction, say a U.S. Delaware Corp, or do you have two? It unfortunately it opens a can of worms when you figure out which entity is recognizing revenue from which jurisdiction, um, and transfer pricing. If you have a single entity, you can simplify quite a bit. How would you recommend handling this? I think, we love single entity. All right, that simplifies it. And our answer is always going to be sort of uh, impacted by the fact that we love data and we love detail and nuance and love to analyze it. So we would bring more complexity. What do you recommend, Ben, for just keeping it pretty straightforward, knowing that, pre-seed, they don't have internal resources and a big budget?
Yeah,
You're on
on
mute.
this
Oh,
one,
yeah,
oh,
you're pinned.
oh, can you hear
Yeah.
me?
Sorry. No, you're
Yeah.
good.
Um, yeah, and we've both seen a lot of bad accounting, and sometimes it gets so far down the road that it's really hard to untangle, especially if you're going to then raise the seed in the Series A. So I'd say in this case, you're not in a tough spot, but I think you do need to allocate some funding to a bookkeeper who knows this. And of course, we know who can help you here, but uh, where, yeah, you need the proper structure in place, especially if you're invoicing in different currencies, and it's single entity definitely helps, but then having accounting software and that setup that can handle multi-currencies and all that stuff, and what's your local currency that you're going to convert everything to. So I do think you probably need to start sooner rather than later to get someone to get this properly set up. Otherwise, it's going to be a mess down the road.
Yeah, I would recommend speaking with someone like Monpack who has familiarity with this. Just, even for a introductory free call, we could probably give you some good insights onto how to do it. If you set it up properly, it can be maintained, but at least you'll have that infrastructure in place for the future need. The assumption is you're going to grow, become a huge company, raise capital, and eventually exit. It's hard to go back and rebuild a foundation sometimes when the house is already built on top of it. That's all. But good question, kind of a classic. Here's another classic question about did you read this, Ben?
Mhm. Yeah, I'm reading it. Yeah,
It's
right now.
usage versus ARR. You like the value of the ARR, but
Yeah, yeah. In this case, yeah, in our case, customers commit to a set number of credits, and we count that commitment towards ARR, which is fair if they've have a prepaid or a commitment. If it's pure usage based, it's hard to say what that ARR is. But you say our preferred model would be a very low subscription fee with customers paying based on actual usage, so hybrid platform. That may be better. So yeah, I think better for same predictable. Yeah, this is where you just need a little history because, all right, if you have subscription plus usage, if we run our MR schedules and our retention off that usage, we want it to look just like subscription to get that same credit. So if we can show that predictability, it's recurring, it's not too seasonal, it's moving up and to the right, then you should be able to get the same amount of credit for your usage ARR as you do a subscription. So again, it comes down to retention, predictability, and that's always the balance the founders are playing is like, well, maybe it's better for the customer with usage, but then investors or valuations will be more subscription based. But it's tough, but they're going to look in that usage just like subscription. And your job is like, can I frame up usage revenue just like subscription revenue?
yeah, and I think it should just be GAAP, and make sure it follows GAAP and you don't get too aggressive in your treatment of this because eventually in diligence, someone's going to question it or an audit, and you don't want that deflation of your valuation coming from the wrong accounting rule being applied here. I think, if you're growing fast and you're making money or at least scaling quickly, I'd be less concerned whether it's ARR or usage. But I run a company, with what 400 plus employees, and it's almost some fixed, some and it's some variable, but we don't have outside investors. So I look for the profit and the cash flow versus something that's going to attract investors. You kind of have to do both when you're living in both worlds. But I think investors' perceptions will kind of change because usage is now more important, right? They may have to think differently about ARR as the main value driver and more what is, gross revenue retention or net revenue retention because of usage. And if your product's great, you'll get that.
Hmm. Yeah.
So that's kind of covers our topics. I don't know, Don, you think we should,
Yeah.
or Ben, you want to, as a recap, go through your slides real quick, or should we just open it to more questions?
Well, I was going to check and see. Just open it up for questions. I'm going to take one more quick stab. What are some of the best usage metrics you typically see and how to calculate them? There's a question there.
Mhm. Yeah. Yeah, we don't have enough time to go into, the calculations, but I definitely suggest my blog for some of that stuff. But yeah, with usage revenue, again, we're still going to look at logo retention, gross revenue retention, net revenue retention, but gross revenue retention can be harder if it's usage based because if they contract in a month, right, GRR is kind of unusable. But what then I look at is GRR that excludes the contraction piece. So GRR, that's truly lost only to show what customers stay on the platform are usage revenue each month. So still going to use a lot of those same metrics for usage-based revenue, but we may tweak them. Also ARPA, average revenue per account, is that moving up and to the right? How much are we yielding per customer? That's a good story to tell if you can yield more per customer. And this gets to in my slides, I have a revenue density metric, which is the inference efficiency ratio. If we're especially LLM based delivery, is how much revenue are we producing, say through via through 1 million tokens, for example. That's becoming more important now is revenue density and efficiency for our customers. That maybe what used to take 2 million tokens to produce that outcome is now 1 million tokens. So that's why some of this data is so important. So I don't know,
Yeah, and it may
Monty, any
vary by
thoughts?
customer size, right?
Yep.
Or
Yep.
cohorts. And that may influence you to redirect some marketing spend or some account management effort to get people into the right tier because that is a more profitable size client for you or something like that.
I'm going to try. Let me give this another whirl here. Hey, how do you like that? So basically,
That's
a lot
it.
of the questions that we heard today was around the accounting and accounting practices, and AI is going to be a part of your, accounting practices and how to measure it and so on and so forth. So regardless if you are, pre-seed or looking for funding or just growing and looking to come check out SaaSonomics. It's a combination of Ben Murray, his best of breed finance framework with Monty's 20 plus years of accounting expertise. And essentially, we go through what the problems are. Inadequate accounting leads to bad decision making. We'll provide to you what we believe the solution is done right from the ledger all the way to the board deck. The benefits and the outcomes, better decision making, faster, cleaner due diligence. And who delivers this? It's a combination of Ben Murray and Montpack. In the middle is SaaSonomics. Here's a way to get a hold of us. Again, this is not a sales pitch. We're here to listen to Ben and Monty. I'm going to send this deck to everybody, but a lot of the questions were around accounting. If you liked what you hear today, give us a call, and would love to provide a free estimate on what we believe you need to get your books kind of going in the right direction. And so let me come back in here and see if there are any additional questions. And so far, no other additional questions at this point. Gentlemen,
Yeah.
any last thoughts? Anyone in the audience, any last questions? Ben?
Yeah, guys, yeah, happy to take any questions here, just kind of free Q&A. And then email me if you want those slides, ben at thesascfo.com. And, Monty, you see this too, but, I work with a lot of founders and they come to me and usually they're unhappy with their accounting, their bookkeeper. And the big thing is their bookkeeper doesn't know SaaS, they don't know AI. And then we've got to completely revamp their chart of accounts, renovate all their financials, get numbers in the right spot. And if you're kind of, I'd say, if you're scaling, you're growing nicely or growing, that's when it's time to think about, getting this in order because it yeah, it just gets messier and messier as you go on.
Yeah. Great point. I think it's, a combination of setting up the infrastructure right, planning for the future, and choose an accounting resource that is looking around corners a bit on your behalf. There's a quick follow-on question about what about systems, software systems to recommend. I think QuickBooks Online still works. It's flexible. Puzzle up and coming. We're doing an initial client on Puzzle now. That could be interesting. Happy to have a follow-up call with you, Ludovico, to answer any questions, maybe point you in the right direction. And thanks for the shout out of someone who has been recommended Monpack to them. We appreciate that. I think if there's nothing else, we'll let you get back to your day. Don, you want to close us out?
Yeah, no, yeah, everybody, thank you so very much. You'll get an email with everything. If you have any other questions, good webinar. Thank you very much. Thanks, everybody. It was insightful. Had a good time. Thanks very much. We'll see you on the next one. And have a great day. Thanks so much.